This presentation is for Accounting 221, Accounting Principles 1, Chapter 2, Recording Business Transactions. These are the first three learning objectives for Chapter 2 to explain accounts as they relate to the accounting equation and describe common accounts, to define debits, credits, and normal account balances using double entry accounting and T accounts, and to record transactions in a journal and post journal entries to the ledger. These are the last two learning objectives for Chapter 2. To learn to prepare the trial balance and illustrate how to use the trial balance to prepare financial statements, and to use the debt ratio to evaluate business performance. Our first learning objective will be to explain accounts as they relate to the accounting equation and describe common accounts. The accounting equation is the basic tool of accounting. The accounting equation is made up of three categories: assets, liabilities, and equity. Each category contains accounts which are detailed records of all increases and decreases that have occurred in an individual asset, liability, or equity during a specific period. Assets are something the business owns or has control of that has value. Assets are economic resources that are expected to benefit the business in the future. Many examples were introduced in Chapter 1, such as cash, accounts receivable, equipment, building, and land. Accounts receivable represent a customer's promise to pay monies in the future for services or goods already provided. Equipment, furniture, fixtures, and land are assets used by businesses in operations. Two new assets introduced are notes receivable and prepaid expenses. Notes receivable represent a promise by a customer to pay a fixed amount of money along with interest on a specific date. Generally, notes receivable require a formal promissory note, which includes a stated interest rate. Prepaid expenses are expenses paid in advance that are expected to benefit the business in the future. Examples of prepaid expenses include prepaid rent, prepaid insurance, and office supplies. A liability is a debt, something that the business owes. A business generally has fewer liabilities than asset accounts. A payable involves a future payment of cash. A note payable is a written promise made by the business to pay a liability in the future and generally includes interest. An accrued liability is an amount owed for goods or services provided but not yet paid by the business. Unearned revenue occurs when a company receives cash from a customer before the business provides the goods or services. The stockholder's claim to the assets of the business is called equity or stockholder's equity. A company has separate accounts for each element of equity. Equity is increased for common stock and revenues and decreased for dividends and expenses. Exhibit 2.4 shows the chart of accounts for Smart Touch Learning. A chart of accounts is used to organize a company's accounts. A chart of accounts lists all company accounts along with the account numbers. Account numbers are just shorthand versions of the account names. Each account has an individual account number, similar to how Social Security numbers are unique to each of us. The chart of accounts varies from business to business, though most account names are common to all companies. In addition to a chart of accounts, companies need a way to show all of the increases and decreases in each account along with their balances. A ledger is used to complete this task. A ledger is a collection of all the accounts, the changes in those accounts, and their balances. A ledger provides more detail than a chart of accounts. The second learning objective for this chapter will be to define debits, credits, and normal account balances using double entry accounting and T accounts. In accounting, the double entry system is used to record the dual effects of every transaction. A transaction would be incomplete if only one side of the transaction were recorded. In addition, recording only one side of the transaction leaves the accounting equation out of balance. A T account is a shortened form of the ledger and is called a T account because it resembles a capital T. The name of the account is listed on top of the T. The left and right sides of the T account are used to record increases and decreases in the account. Debit is abbreviated as DR and credit is abbreviated as CR. Increases and decreases to an account are determined by the type of account: asset, liability, or equity. Depending on the type of account, increases are recorded on one side and decreases are recorded on the opposite side. Assets are always increased with a debit and decreased with a credit. Liabilities and equity are always increased with a credit and decreased with a debit. Debits are not always increases or always decreases, and neither are credits. The debit or credit designates on which side of the T account the transaction is recorded. Assume a business wants to record an increase of $30,000 to the cash account. They would record a debit to cash of $30,000. If the business instead wanted to record a decrease of $20,000 to the cash account, they would record a credit to cash. The accounting equation is expanded to include the four types of equity accounts: common stock, dividends, revenues, and expenses. Common stock and revenue both increase equity, but dividends and expense accounts increase with a debit, which results in a decrease in equity. All accounts have a normal balance. An account's normal balance is on the side of the account that increases the account. Assets, dividends, and expenses are increased with a debit. Therefore, the normal balance for these accounts is a debit. Revenues, liabilities, and equity increase with a credit. Therefore, the normal balance for these accounts is a credit. Exhibit 2.5 summarizes the normal balances for each type of account. As the table shows, assets, expenses, and dividends all increase with debits and have a normal debit balance. Liabilities, revenues, and common stock increase with a credit and therefore have a normal credit balance. An easy way to remember the rules of debits and credits is to memorize this helpful sentence: all elephants do love rowdy children. The T account is used to obtain a summary or balance of a particular account. The summation of the account is reported on the side of the T account with the larger number. For example, if the total debits for cash equal $35,500 and the credits are $23,200, the normal balance is $12,300. The total of the credits is subtracted from the total debits to determine the ending balance. Our third learning objective will be to learn how to record transactions in a journal and post journal entries to the ledger. Source documents provide the information needed by accountants to record accounting transactions. Based on these documents, the business can determine how to record transactions. After source documents are prepared and transactions are analyzed, the next major step in the recording process is to formally enter the transaction information into the general journal. Essentially, the general journal is a chronological record of each of the transactions recorded in a standardized format. Other source documents include purchase invoices, which are documents that tell the business how much and when to pay a vendor for purchases on account, such as office supplies; bank checks, which are documents that illustrate the amount and date of cash payments, sales invoices, which are documents provided to clients when a business sells services or goods, and they tell the business how much revenue to record. Accountants use the source documents to record transactions in the journal. A journal is a record of the transactions in date order. The journal is not a record holding all of the accounts, so data must be transferred from the journal to the ledger through the posting process. You can use a modified version of the steps for analyzing accounting transactions to help you when you are recording transactions in the journal and then posting the journal entries to the ledger. In Transaction 1, Smart Touch Learning received cash from Sheena Bright in exchange for common stock of $30,000. In Step 1, the two accounts involved are cash, an asset, and common stock, an equity account. In Step 2, both accounts increased by $30,000. Cash is increased with a debit, and common stock is increased with a credit. In Step 3, the transaction is recorded in the journal with a journal entry as illustrated on the slide. The journal entry contains 4 parts: the date of the transaction, the debit account name and dollar amount, the credit account name and dollar amount, and an explanation. In Step 4, the journal entry is posted to the ledger. The dollar amounts are transferred from the journal to the ledger with a debit or credit identical to the debit and credit used in the journal. This step is automated when computerized systems are used to record the business transactions. In Step 5, determine if the accounting equation is in balance. Notice that the accounting equation balances in this example. In Transaction 2, Smart Touch Learning paid $20,000 cash for land. So Step 1, the two accounts involved are cash, an asset, and land, an asset. Step 2, cash decreases with a credit and land increases with a debit. In Step 3, the transaction is recorded in the journal, and in Step 4, the journal entry is posted to the ledger. Step 5, the accounting equation is still in balance because land was increased with a debit and cash was decreased with a credit of the same amount. In Transaction 3, Smart Touch Learning buys $500 of office supplies on account. The supplies will benefit the company in future periods, so they are an asset until they are used. The two accounts involved are office supplies, an asset, and accounts payable, a liability. Office supplies increase with a debit and accounts payable increase with a credit. In Transaction 4, the company collects $5,500 cash for revenue by providing services. The two accounts involved are cash, an asset, and service revenue, equity. Cash increases with a debit and service revenue increases with a credit. In Transaction 5, the company earns $3,000 revenue on account by providing services. The two accounts involved are accounts receivable, an asset, and service revenue, an equity account. Accounts receivable increases with a debit and service revenue increases with a credit. In Transaction 6, the company paid the following cash expenses on November 15th. Office rent, $2,000, and employee salaries, $1,200. The three accounts involved are cash, an asset, rent expense, equity, and salaries expense, equity. Cash decreases with a credit, and the two expense accounts increase with a debit. A compound journal entry has more than two accounts, but the total dollar value of the debits must equal the total dollar value of the credits. In Transaction 6, the debits to the expense account increase the expenses and in turn decrease equity. In transaction 7, the company paid $300 on the accounts payable created in transaction 3. The two accounts involved are cash, an asset, and accounts payable, a liability. Cash decreases with a credit and accounts payable decreases with a debit. In transaction 8, the company collected $2,000 cash from a client in transaction 5. The two accounts involved are cash, an asset, and accounts receivable, an asset. Cash increases with a debit and accounts receivable decreases with a credit. In transaction 9, the company pays $5,000 cash for dividends. The two accounts involved are cash, an asset, and dividends, equity. Cash decreases with a credit and dividends increases with a debit. The debit to dividends decreases equity. In transaction 10, the company prepays 3 months office rent of $3,000. The two accounts involved are cash, an asset, and prepaid rent, an asset. Prepaid rent is an asset because the company will receive a benefit in the future. Cash decreases with a credit and prepaid rent increases with a debit. In transaction 11, the company pays employee salaries of $1,200. The two accounts involved are cash, an asset, and salaries expense, equity. Cash decreases with a credit and salaries expense increases with a debit. The debit to the expense account, in turn, decreases equity. In transaction 12, the company purchased a $60,000 building in exchange for a note payable. The two accounts involved are building, an asset, and notes payable, a liability. Building increases with a debit and notes payable increases with a credit. In transaction 13, the company received a contribution of furniture with a fair market value of $18,000 in exchange for common stock. The two accounts involved are furniture, an asset, and common stock, equity. Furniture increases with a debit and common stock increases with a credit. In transaction 14, the company received a telephone bill for $100 and will pay this expense next month. This results in an accrued liability. The two accounts involved are utilities payable, a liability, and utilities expense, an equity. Utilities payable increases with a credit and utilities expense increases with a debit. In transaction 15, the company paid employee salaries of $1,200. The two accounts involved are cash, an asset, and salaries expense, equity. Cash decreases with a credit and salaries expense increases with a debit. These are the T accounts for transaction 15. In transaction 16, the company received $600 cash prior to providing services. The two accounts involved are cash, an asset, and unearned revenue, a liability. Cash increases with a debit and unearned revenues increases with a credit. These are the T accounts for transaction 16. In transaction 17, the company receives $8,000 cash prior to providing services. The two accounts involved are cash, an asset, and service revenue, equity. Cash increases with a debit and service revenue increases with a credit. These are the T accounts for transaction 17. After recording the journal entries, the amounts are posted to the ledger. Exhibit 2.7 is a summary of the ledger accounts. The accounting equation is in balance as assets equal $114,700 and liabilities plus equity also equals $114,700. This exhibit 2.7, notice the liabilities and equity values of $60,900 and $53,800 do equal the total assets of $114,700. This slide illustrates the T account. The next slide shows an alternative, the four-column account. The four-column account is an alternative to the T account. The four-column account has debit and credit columns as well as a running balance of the account. Similar to the T account, the four-column account lists the date of the journal entry, a posting reference, and the debit or credit amount. Exhibit 2.9 shows the posting and associated posting references for Transaction 1 of Smart Touch Learning. This process is automated in a computerized environment. In the fourth learning objective, we will learn how to prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. A trial balance is prepared after the journal entries have been posted to the ledger. The trial balance is a summary of all the accounts with their balances. The trial balance lists the assets, liabilities, and equity in that order. The purpose of the trial balance is to check whether or not the debits equal the credits. Note, the trial balance and the balance sheet are not the same. The trial balance is an internal document used to verify that debits equal credits. The balance sheet presents the accounting equation and is a financial statement that is used internally and externally. In addition to verifying the equality of debits and credits, the trial balance is used to prepare the financial statements. The account balances are taken directly from the trial balance to prepare the income statement, statement of retained earnings, and balance sheet. If the debits and credits are not equal on the trial balance, an error exists. Balance errors can be located by performing a search on the trial balance for any missing accounts. Dividing the difference between total debits and credits by 2 locates doubling errors, which occur when a debit is treated as a credit, or vice versa. Transposition errors, for example, when an amount was recorded as $2,100 instead of $1,200, may exist when there is an out-of-balance error. If the result is evenly divisible by 9, the error may be a transposition or slide error, such as recording $1,000 as $100. Our last learning objective will be to learn how to use the debt ratio to evaluate business performance. The debt ratio is used to evaluate a business's ability to pay its debts. The debt ratio shows the proportion of assets financed with debt. Companies with a high percentage of liabilities are at greater risk of default, meaning they would be unable to pay their creditors. This is the conclusion of the presentation for Chapter 2.